The last decade. So the last decade, we've seen a 340x% increase in the S&P 500. Huge increase. 340 something percent, 5% of the S&P 500. And at the same time, we've only seen a 40% increase in the PE ratio. We're going to talk a little bit more about that in a second. Something I want to look at here is there are 3 periods here where we level off for about 2 years. Right now, we're at the end, and maybe it keeps going. We've got about a 2-year period where we get a pretty straight line, right? So that's interesting. And if you look at this is a stretch, but a lot of people are worried about the market pattern right now, the zig and the zag and the up and the down that exists in this last 2 years. Just really quickly, compare that to that period in 10, 11, where you had an up, a drop, an up, a big drop, a slower up, another big drop. It's almost an identical pattern. And guess what happened after that? 280% something increase. There is nothing in these patterns. The zig and the zag is meaningless, right? There's nothing that says, oh, it's going to end now because of this zig and zag. 2009, then and now, 2019. So some major changes. The biggest one here is at the top. The employment, the number of people working in 2009, 27.1 million. That was down from about 29, 30 million. Down from 30 million. Today, 36.8 million, almost 37 million working. So the number of people taking home a paycheck, the average pay for which is actually higher, is huge for our 70% consumer-driven economy. It's a massive thing, very positive. Yeah, home prices are up, and home ownership is actually down a few percent. Look at, and we'll get deeper into this in a second. This is the wealthiest and the poorest. That's the wealthiest 20% and the poorest 20%. So the wealthiest 20% have seen an increase in their average income of about 30%. The poorest have seen an increase of about 15%. That equates to about a 1% increase per year for the poorest. This is real after inflation is accounted for. So this is actually a real increase. So there is an increase in this separation. Household net worth, high as it's ever been. 108.6 trillion at the end of the first quarter, which is a complete recovery from the decline we saw in the fourth quarter of 2018. So we want to spend a little bit of time here because we know that gains have been concentrated at the top end of the market in terms of the wealthy have gotten wealthier. And what we see here is the top 10% have grown 5x, 4 to 5x in terms of their income and their wealth, as the bottom 40%. And if you break that out even more, we all know that if you break that to the bottom 10%, it's very negative. Long term, this is not good for our economy. Our middle class you can be middle income without being middle class. You can have middle income, but with college education prices, with healthcare prices, with the price of housing that we saw earlier, it's very difficult to enter the middle class with a middle income. You have to have a higher income to enter the middle class. This is something that I assume will be resolved with policy, not probably in the next 2 years. It'll eventually be resolved. We will resolve it. But it's something to think about. So when you're thinking about something you can do in a community, mentoring somebody that's coming up is huge. Supporting someone that's working really hard to make something happen but isn't quite there, huge. Something we can all do. Yes.
Why do you say it will be resolved?
The pendulum swings both ways. It's not going to be resolved in the next 2 years, but the pendulum does swing both ways. So we've gone very, very, very to the benefit of wealthy, and the pendulum will swing back the other way. And if you look at the new Congress, that's just step one in the pendulum swinging, right? I think the public is saying it's time to shift this the other way. And so we will see the shift. It just takes time and energy. This is interesting because this shows the boomer generation, those that are a subset of the boomer generation, the X generation, and the millennials. Those 3 bars. So the bar on the left is those people who are 35 in 1995. The middle bar is those people who are 35 in 2004. The right is the millennials, those people who are 35 in 2014. And that is net worth of those consumers, age 35, at that point. And you can kind of see a steady decline in the net worth. So it's actually not a huge, I mean, the graph makes it look big, but it's 12,000 to 8,000, which is about a 30% decline in that period of time. What do you it's net worth. What do you think makes up the majority of that difference in net worth? Loans, student loans, student loans. So it's net. So if they have a house, the house has got a lot of value to it, and it's gone up quite a bit in the last 2 or 3 years. The big difference is the student loans, which means students graduating, or the millennials who graduated 10 years ago, have about $4,000 more in student debt on average than those people who graduate, than the boomers who graduated. That's a net worth, that 12, 10-ish and 8-ish. I will say though, just notice this, that the big jump is between the 1995 and the 2004. So it was actually my generation that suffered the most, not these millennials, just to be clear. This is being filmed. This is great that that's going to be on YouTube. The first half of the year has been pretty awesome, but what we want to look at is the difference between the first quarter and the second quarter. Why was the first quarter so nice? This is the interactive portion. Why was the first quarter so good?
The Trump tax cut?
That was last year.
Before was really bad.
Boom. It was a recovery from the fourth quarter that was awful, right? So second quarter is kind of more realistic for a quarter. And I'm assuming if we all took that 4-ish% growth in the second quarter in the S&P and we multiplied that times 4 quarters, we'd all be pretty happy with that for the year, right? 16%, it's a pretty good year in the S&P. Year to date, it's been a very good year. We don't know what the rest of the year, we'd like to close it for the year, that'd be awesome, but we don't get to do that. We got another 5.5 months to go through. So something really interesting about this last one is this Barclays US Ag, Q1, Q2. That is the best first and second quarters for the bond market since 1995. And now we can go forward and we'll see what happened. See the top blue line? That's the fourth, that decline from over 3% to 2% is the US benchmark bond 10-year, and that's the decline in the interest rate. And what happens when interest rates go down? Bond values go up. Rates go down, bond values go up. So we had a fantastic first half of the year because rates have plummeted. Now we're going to play a little game here. See this? This is Germany and Japan, and they dipped into negative territory in 2016, and now they're back strongly in negative territory, which means that if you lend money to Germany for 10 years, say $10,000, they'll give you back $9,700 at the end of those 10 years. That's negative interest rates. So what causes that? What is it that pushes rates down so far?
Are you spending too much?
No one's going to try? Okay. So let's pretend for a second. We're going to pretend that, I figured this out earlier. I got to make sure I get this right. That Scott wants to borrow money. And everyone here says, we'll lend you money. We'll lend you money. We'll lend you money. How does Scott choose who to borrow from?
Lowest rate.
Lowest rate. So there's an enormous amount of money that's looking for a safe place to go. There's an enormous amount of German money, an enormous amount of Japanese money. And in the United States, in the fourth quarter of 2018, there was a lot of money looking for someplace safe to go. Because what was happening? Markets were cratering. Markets were down about 20% in the fourth quarter. And when that happens, you see a flight to safety. And so everyone put their money, took it out of stocks, and you can see this in the flows, take it out of stocks, and they bought bonds. What happened right after they did that? Stocks recovered. Right, this is a sort of a natural tendency. But now bond rates, you see how in the US, we went up, bond rates kind of ticked up, and now we've come all the way back down. And that gives us this. The blue line is a normal yield curve. The green, is that right? green, brown, orange, depends on the angle you're sitting at.
The broken one.
The dotted line. The dotted line is an inverted yield curve. So you've all read about an inverted yield curve. So what that means is long rates are lower than short rates. So you can, the federal government or any government will actually lend you money long for less, thank you, than they'll lend short. So they're paying more on the short end. Why does that happen?
No confidence in the future.
There's an expectation of a slowdown. So that's very clear in the bond market. And the inverted yield curve, the 10-year over the 2-year, if that's inverted, that's the thing that tells us that a recession is coming. What we have is we don't have that. We have a 10-year over a 6-month, a 10-year over a 3-month. We don't have a 10-year over a 2-year yet. So we've seen inversion, but not in the piece that actually is the part that scares us a little bit. And this yield curve is tortured because there's so much money being invested in that long end of the curve. So JP Morgan reported emotion can result in poor decisions, right? So we talked about markets went down, stock markets went down, people got nervous, they sold their stocks, they bought bonds, markets recovered. So look at this can you guys read that quote in the middle? Not quote, but that statement in the middle. The best day of 2015, August 26th, occurred 2 days after the worst day, August 24th. So what that means is markets are volatile, they zig and zag. We can just expect them right up front to zig and zag. When the thing goes down 4%, it's likely to come back in the next couple of days 2 or 3%. That's just how this thing works. Okay, that's the sun rises, the sun sets. If you miss the 10 best days, if you're fully invested long-term in the S&P between 98 and 2017, fully invested that whole time, you get a 7.2% return. That's not including dividends, that's just the return in the market, okay? If you miss 10 days, the 10 best days, again, many of those follow the worst days, so if it goes down, you panic, you get out, your average is 3.5. If you miss 60 days, this is over a 20-year period, so this is probably 4 times of getting upset and running, your average return goes from +7 to -6. What is this an argument for? Staying invested. Investing in an appropriate portfolio that fits your plan and staying invested. What's the one caveat that we'll talk about that you do? What do you do on a regular basis? You stay invested, but what is it? Rebalance. God, this is great. Everyone learns. I love it. So we're going to spend a couple minutes here talking about our recipe, the thing that we do that I think makes us different than most other firms. The thing that we do is a lot of this education stuff, and we focus on planning. I'm going to talk specifically about portfolios and some things that people might forget. So we're going to go through this. So we are a global investor. We do not invest just in U.S. companies. And if you're a global investor, when U.S. companies outperform everything else in the globe, that means you underperform for that period of time. And that's okay. We're signed up for that. We agree with that. That makes sense. Because let's say you're going to have a workout. We're going to explain Sharpe Ratio. See that the triangles go from the top left to the bottom right? These are ordered by Sharpe Ratio. What is Sharpe Ratio? It's return per unit of risk. So let's put it this way. So you go to the gym, you do a 1-hour workout, and that 1-hour workout, it's the same workout. Would you rather burn 42 calories or 26 calories? Same workout. 42 calories. Right? You want to get more for less input. You want to get as much as you can for as little input. That's what that Sharpe Ratio says. And that left bar is asset allocation. It's the broadly diversified portfolio of all of these things. Notice the Russell 2000, you're looking at each one of those segments. I'll read the bottom here. The blue on the left is excess return. On the right is standard deviation, which is volatility. It's a measure of zig and zag, okay? So on the left, excess return. The right of each of these parts is risk. The triangle is return per unit of risk. And you notice you might have a better return in any one of those other things, but you've taken way more risk to get there. Are we clear on that? So when we think about return, we think about risk-adjusted return. We're trying to get people to where they need to go in the smoothest possible fashion. We always use diversified portfolios. Asset allocation is our hallmark. We're going to talk more philosophy here, more of our recipe. So this is going to be very busy. I'm going to talk about this right here is the United States. The next two slides present the exact same thing for international and emerging markets. And this is probably the single biggest difference between us and most of our peers in how we invest. Okay? So these are 10-year rolling returns. So every one of those bars represents the 10 years that end on that day. Okay? When it's above the line, it's an outperformance. Below the line, that puke yellow, green color, that's an underperformance. Okay? So the top one is stock market over T-bills. So we believe, and this is just data, stocks outperform bonds. They do it with a lot of volatility, but usually over long periods of time, they outperform. And you can kind of see all those places they outperform. The next line, and this is where we get into the details of how we do things. Small companies outperform large companies. So that's small cap performance minus large cap performance. Okay, I'm going to go blue and yellow. Can we do blue and yellow? Okay, blue and yellow. So value minus growth, you can kind of see all those times it's leading is the blue on the top. And the last one is high profitability, low profitability. When we build our portfolios, we focus on value, small cap, high profitability companies. That's what we look for. That's what we tilt towards. That being said, I want you to look at the last 2 years in every one of those categories. The last 2 years in small cap minus large cap, you have a much smaller benefit. The last two, and I'm going to skip value. The last 2 years in high profitability minus low profitability, one negative year, one small benefit. And the last 7, 8 years on a 10-year rolling basis, so that means for the last 18 years, value has underperformed growth. When was the last time, you can look right on the data there, when was the last time value underperformed growth at that level?
During the Depression.
You can kind of see the last time it underperformed for those 12 years. It shows 2 years on here because it's rolling, but the prior number of years to get to that 10 years, that's what that means. That's the .com. So when you have a period of time when a specific subset of growth equities outperforms everything else, value underperforms. Guess what we have now? Guess what we've had since 2008, right? We've had FANG stocks. When you look at the growth of the S&P 500, the vast majority, over 50% of the increase, comes from 8 or 10 stocks. It comes from FANG. Everyone knows what that is? Facebook, Apple, Amazon, Netflix, which has just been crushed. Because Disney, which is on the value side, has now come up and said we're going to compete with Netflix. And Google. And then you think about Microsoft and you think about a couple others in there that are massive, that have driven all the return of the entire S&P 500 index. If you take out the top 50 companies of the S&P 500, the other ones have all underperformed. Okay? So eventually, I don't know when, eventually, value comes back. Value always comes back. Why? Growth is the hot dot. Growth is the thing that we all chase. And as we all pile into the thing that's attractive, the more we pile into it, the more we ignore companies that are growing their earnings and doing really well. And that thing that we pile into goes up and up and up and up. And it looks really exciting, so more people go, oh, I want some of that. And they sell the stuff that's not as exciting, and they move into that thing. And then that goes on for a little while. And because those people sell their value or sell their boring stuff or their international stuff or their bonds to buy the thing that's really exciting, it pushes up even more. And that happens until there's no more money to sell and go pile into this thing. It happens when you have a 25 or a 30 PE ratio. It happens on a very, very, very regular basis. I mean, when you look at growth versus value, that third line, the vast majority of time, value is leading. Value is leading. The 10-year value numbers are better. You're outperforming with value. And it makes sense because eventually investors want what? When you invest, what do you? Earnings. And you want earnings at a good price. So eventually investors seek out as much earnings as they can get for the lowest price they can get it. And that's how companies get valued, is they provide earnings. They say to the market, these are our earnings. And people go, do I want $1 worth of earnings? Do I want to pay $18 for this $1 worth of earnings? Or do I want to pay $12 for this $1 worth of earnings? Does anyone have an idea which you choose?
It's like the workout.
Exactly. It's the exact same thing like the workout. If I can spend $12 for $1, I'll do that all day long instead of 18 for $1. But that's rational. Markets aren't rational. Markets are exciting, and there's people looking for, the next hot thing. That's a long-winded answer to the question. But does that answer the question? Okay. Same story international, same story emerging markets. Very, very simple. So this is a very jagged line. This is volatility. What I'm pointing to here is something we've talked about a lot in this room. Look at 2017. I miss 2017. Such a great return, no volatility year. We're sort of back to volatility. You kind of see the 18, 19, the base is like at 13. Look at 14, 15, 16, base is about at 13. 17 was so nice. Base was at 10, 9. So volatility's here, and it's something we should just expect to be part of the story going forward. People always forget that when there's a tariff announcement and there's a nervous sell-off in markets, so they always think that the sell-off is here to stay, but they always forget that there's other people thinking about stuff. And the Fed steps in and says, you know what? We think we're probably going to lower rates, or we're ready to lower rates if it's necessary. Now, there's a lot of Fed speak out right now. I want to talk really quickly about the Fed Board of Governors, because there's two things I read. I read in one place that they're saying we're not going to raise or lower, we're going to keep things the same. I read in another place that they're going to drop 50 basis points. Why do we have two sets of data, right? It's very simple. There are 17 board governors. There's 12 regional governors. There's 5 on the federal sort of ad hoc. There are 10 voting members. So the 10 voting members, the median goal for those 10 voting members is a 50 basis point drop in a couple days. The median of the 17 is no drop. So what that means is 6 of the non-voting members are voting no drop, but they're non-voting. They don't actually get to say anything, right? So the voting members are the ones that get to determine where this thing goes. Their median is a 50 basis point drop. I think there'll be an argument. I think we might see a 25 basis point drop. It's possible we see a 50 basis point drop. If we see a 50 basis point drop, equity markets are going to be very happy. Equity markets are going to move, but we won't see another drop then. That's not slow and steady. That's not data dependent. That's just, we're nervous, Trump's an idiot, we're going to drop it, right? So that has a follow-on problem. If we actually do see recession, if we actually do see problems, which I think that's not a foregone conclusion, but if we do see rough patches, we have less room to respond. So we actually do want rates to go higher, but it does kind of make sense. Some of the arguments do make sense to drop it a little bit. I don't know what it's going to be, but we're going to find out in a few days. So these are the things that when the Fed lowers rates, this is what they're hoping for. They're hoping for more borrowing, they're hoping for business starts, spending, they're hoping for export growth, they're hoping for jobs to be created. My question is, does the 10-year at 2%, which means you add a little bit to it, your mortgage is going to be 3.5%, does it stop anyone from doing anything? Is that too high? No. No one is not investing because rates are too high. So this is completely a confidence move. This isn't because the market's going to benefit from it. This is a pure, the Fed's on the watch, we're going to do something about this, confidence move. So let's hope it goes for us, not against us. Fair? And here we are. This is the earnings per share expectations. This is lots of analysts looking at this stuff going, this is what we can expect. This doesn't look bad in any way. Earnings look like they're going to be fine. We do see first quarter of this year had a dip, little increase, but look at the first quarter of next year, little dip. Look at the first quarter of last year, it was lower. It was a huge increase over the prior year because of the tax cuts, yeah. So earnings are looking very, very, very good. And this is just a math problem. We talked about it earlier, right? The PE ratio is just, you have earnings, now what price am I willing to pay for those earnings? In 1999, we were willing to pay $25 for $1 of earnings. That's a 25 PE. That's crazy. And it proved crazy after the fact. Today, we're willing to spend about $18, $18.50 in the United States for $1 of earnings. Guess what we're buying $1 of earnings for in Europe? 14. Emerging markets, 10, 11. Right? So people ask us, why do we have more international? Well, one, we talk about diversification. Two, it's where earnings are cheap. Will it recover? Will they grow again? Yes. When? I can't tell you. I don't know.